Hello and welcome to Ticker Tapes. Today we're back in the world of ETFs. We had a reminder of just how quickly investor sentiment can turn over the last week. Equity markets enjoyed a strong run higher from mid-June, which gained further momentum following the July FOMC meeting, after which investors seemed to be convinced that the Fed would pivot in 2023 and start cutting rather than raising interest rates once more. However, that confidence was severely dented this week by a mix of uninspiring data and a rapidly evolving energy crisis in Europe, where natural gas prices have spiked higher once more, and industry is planning for the genuine possibility of energy rationing and shutdowns, all of which spooked U.S. investors and saw the Nasdaq 100 fall by almost 5.7% over the last 5 business days, in which the index posted just one positive session. Despite that setback, there were continued inflows into U.S. equity ETFs. QQQ, which tracks the Nasdaq 100 index, saw inflows of nearly $1.2 billion, and IVV, the iShares Core S&P 500 ETF, attracted $1.31 billion of new investment. The biggest inflows were seen in XLF, the Financial Select Sector Spider Fund, which was bolstered by $1.55 billion of new money. The fund tracks the S&P 500 banks and financial stocks, a sector which has been under pressure for much of the year to date and is down by 12.45% in that period. What's more, following last week's sell-off, just 1.5% of the stocks in the sector are trading above their 5-day moving average. Of course, data like that may be an attraction to investors if they believe that the banks and financial stocks are due a re-rating in the months ahead. Bond ETFs saw the largest outflows last week. Underlying bond prices fell and yields rose as investors' concerns about the economic outlook came to the fore once more. Some $3.3 billion was redeemed from a clutch of funds that included BIL, the Spider Bloomberg 1 to 3 month T-bill ETF, which lost $1.06 billion, and SHV, the iShares Short Treasury Bond ETF, which saw $716 million fall out of the door, according to FactSet data. In terms of price gainers last week, natural gas-linked ETFs were among the best performers, with UNG and GAZ up by 10.57% and 12.21% respectively, while UNL rallied by 8.79% and FCG by 5.79%. However, they were all eclipsed by PFIX, the Simplify Interest Rate Hedge ETF, which added 15.36%. The fund aims to provide investors with a hedge against sharp rises in long-term U.S. interest rates, and to do so, it holds a mixture of interest rate options, inflation-linked, and plain vanilla treasury bonds. Year to date, the fund is up more than 53%, so the strategy seems to be working. PFIX currently has around $293 million of assets under management and has seen $115 million of net inflows so far in 2022.